derivatives and alternative investments. So that when we look at the fixed income side, we have reading 39, which basically defines what fixed income securities are. Then it looks at preliminary issues like indentures, regulation, taxation, cash flow, contingencies, and those kind of stuff. The 40 basically looks at the markets, both the primary markets and the secondary markets. It looks at the issues of trading and funding. And then we look at different types of bond issuers and the different types of issuances. Then we look at corporate debt and funding alternatives. Then when you go to 41, it's basically bond valuation and yield to maturity. So we look at things like spot rates, accrued interest, yield measures, yield curves, yield spreads. And then we move on to 42, which is looking at asset-backed securities, particularly structure of mortgage-backed securities. What are the prepayment risk and what are the other kinds of ABX, which is asset-backed securities. Then when we go to 43, it's talking about understanding the risk-return trade-off, so that we take a look at the sources of return. Particularly, we'll be looking at the concept of duration. They will look at interest rate risk and money duration. They will extend it to convexity and yield volatility. Then the 44 is just looking at credit analysis, so that if you are an investor who wants to put your money into fixed income, what are the sort of things you would want to take a look at? So that is the one that is covered under 44. Then when you go to the next one, which is study section 15, it's just made up of two broad subject areas. So it looks at derivative markets and instruments. Particularly, you look at what are the forwards, what are futures, what is the distinction between forwards and futures, and then what are the cash flow implications. Then we look at swaps and options. Swaps, the focus is on plain vanilla swaps, like an interest rate swap between two counterparties. Then options, we are particularly we're just going to focus on plain vanilla options, like what are call options, what are put options, and then what are the risk return profile, cash flows of such. Then we go on to the 46, which is talking about the basics of derivative pricing and valuation. So how do we price a forward? And then how do we price futures? What are forward rate agreements and what are swap valuations? Then option valuation, and then using the put call parity. Then here we're talking about, are we able to use the binomial model in order to find the value of options? Then the final side is just alternative investments. And this alternative investment is looking at instances of when we look at the various asset classes. We know that we have equities, we have fixed income, and then to some extent, we can use derivatives in order to manage price, transmit risk in those financial assets to other counterparties. So that is why derivatives will come in. We can also speculate on derivative positions in order to make profits. We can also use derivatives to take advantage of mispricing the market in order to make arbitrage profits, etc. Then we are saying that this notwithstanding, we have other alternative asset classes where the correlation coefficient between maybe those asset classes and another asset class is either zero or it's in the negative up to -1, for which reason we can use those assets for purposes of diversification. That is where we go to assets such as historically and also empirically and by research, it's been found out that the correlation normally between alternative investment classes and the traditional asset class of fixed income and equity is quite low. As a result of that, it's a good hedge for fixed income and also equities. So we'll take a look at hedge funds. The hedge funds here, we'll look at various types of hedge funds, whether it's macro hedge funds, is debt arbitrage, is relative, is equity long or equity shorts, or whatever, different kinds of strategies, whether it's a convertible arbitrage or whatever. Then there's the element of private equity or private capital. So we take a look at that. Then there are elements of natural resources, real estate and infrastructure. And then how do we do performance appraisal and calculate returns in terms of if you want to know how much returns you are getting on your investments. So those are the key elements of book 4. So what I would say is that, given the fact that some of us have already started learning, I want to find out what exactly or which areas of the curriculum we need help so that we can take a look at that quickly, and then we take it from there. I don't know whether that works with all of us, because we cannot cover the whole of the book. Even if I start from first principle, we will not be able to get anywhere within 2 hours. But then I'm ready to just listen. And then if anybody has a specific area that you want us to touch on, then I'm open to that. Is that okay?
Yes, I think it's okay.
Okay, so which area or which areas do we need hands from the society that you want us to just quickly?
Hello.
Yeah, hi.
So for me, the parts, I don't know if I got you well, you were cracking up a bit, but for me, the parts in fixed income that's a bit worrying has to do with the convexity and the yield spread or whatever. Yeah, when I see questions, especially the intuitive questions, they're a bit confusing. That's what confuses me, actually. Thank you.
I think I lost my connection. Can you hear me, please?
Yes, Western, we can.
Okay, sorry.
So somebody spoke. Did you hear the person?
No, please, I didn't hear a word. I was. So can the person come back again?
Yeah. And what I heard was convexity. So she was asking. Okay.
Yes, I said usually the bond duration, bond convexity, and spread questions confuse me, especially the intuitive one. When it comes with the calculations, I'm a bit okay with them, but the intuitive questions confuse me.
Okay. Okay. So your issue is that when you look at things concerning the bond side, like duration, convexity, and they ask intuitive questions, you get a bit confused. Is that the meaning? Okay. Okay.
Yes.
So let me.
In picking the right answer. Yeah.
Okay. You see, when it comes to bond valuation, you are basically asking yourself which is closest to, which one is not accurate, the most accurate, which one is less accurate, which one is most likely. You know, the CFA curriculum is like that. When they're asking questions, they say which of them is closer to, which of them is, a bit. So you need to be able to say that when I get a question, is there anything wrong with the answer choice A? Is there anything wrong with the B? And then which of them is closer to what I'm looking for as much as possible? But when you understand, for instance, let's say we want to do something on, let me ask a simple question. I have the price of a bond. They have percentage change in price. And then we say this percentage change in price is basically going to be coming from two sources or probably three sources. So if I take the price of a bond, I'm saying that the possibility that the price change will come from three sources is high. Number one, passage of time. Number two, what we call interest rate risk. And then the third one is what we call interest on interest. So what does that mean? Because intuitive questions, that's the thinking. So if I take the price of a bond, assuming that you bought a bond and the bond that you bought was trading at discount. Discount means that the bond is trading at a price lower than the face value of the bond. What then is the face value of the bond? The face value of the bond is the amount that the issuer promises to pay at maturity, or the amount that you have invested in the bond if it's a coupon bond. So for instance, Government of Ghana issues a 2-year bond, and I put 1,000 Ghana cedis in order to purchase a 2-year that bond from the primary market or whatever it is. And then the coupon rate on the bond, which is the interest rates that government promises to pay, is about 25%. Then at much, they will pay 25% semi-annually, because bonds in our country, they pay semi-annually, which means that the 25, I'll get 12.5 of the amount I have invested in every 6 months. Then upon maturity of the bond, the 1,000 will be returned to me. That 1,000 that is being given to me at maturity is what we call the face value of the bond, or is the principal payment. And in this case, the principal is made by bullets because the whole thing is coming at a go. That is also the maturity value of the bond, because the bond is maturing and then I'm receiving the 1,000. So the 1,000 is the maturity value of the bond. But assuming that the bond as purchased, the intention was to hold it for a 2-year period. But in the course of time, let's say after 3 months, you need the 1,000 to do something with. So you decide to sell that bond. when you are selling that bond, you are going to sell it in the market, in the secondary market, because government, as they have issued a bond, will not be willing to, at any time that somebody needs the money, you go back to government and say, I need my money. No. So they allow a secondary market trading in the bond. So a trader can sell it to another person in order to generate liquidity. So in this case, if the bond that you are selling, if assuming it was issued at 25% before the inflation of 31.7, the inflation figure came. As a result of that, assuming that the bonds that they are issuing, or they issue that close today, they issue on Monday, that is what we typically call on the run bonds. So those on the run bonds, because the yield has increased, it will actually render the bonds that were issued prior to the one that will be issued on Monday inferior. As a result of that, they are likely to trade at discounts. So if these bonds are trading at discounts, what is going to happen is that if all things are equal, then buying the bond at discount, when you hold it to maturity, you can buy the bond, assuming the face value is still 1,000. Trading at discount means that the yield has moved up, so that the yield to maturity of the bond is higher than the coupon rate. As a result of that, the bond is going to be trading at discount. When a bond is trading at discount, when you hold all things equal, if you bought it at a yield to maturity and the yield to maturity remains the same, holding the bond, assuming you bought it at 800 or you sold it at 800, whoever bought it at 800. So 800 instead of 1,000. When you hold a bond and you do nothing, when you get to maturity, you still receive 1,000. So you realize that the distance between the 800 and the 1,000 is not as a result of any change in the yield or income, but it's as a result of the passage of time. That is why we are saying that the price of a bond can change with the passage of time. Is that side clear? Is it clear?
Yes, please.
Okay, so if this side is clear, then the next thing I want to say is that if you're calculating the return on the bond, assuming you hold a bond for the first 6 months and they pay you coupon, if you reinvest those coupons at a particular rate, you still earn a return on the coupon on the original bond. So that is another source of that kind of pricing. Then there is the change in yield. Like I said, the bond was issued at 25%. It's now maybe issued at 32%. Then the change is as a result of interest rates. And these interest rates in bonds balance, we call it yield to maturity. Then the question we ask ourselves is, there is the possibility for the bond, the yield to maturity to fall. Instead of the yield to maturity to increase. Instead of the bond, there's an inverse relationship between the price of a bond and the yield to maturity. But instead of the bond price is going to go up anyway. But then if you're calculating the return, when I say the return sources will be interest on income, change in the yield, and then a passage of time, it is possible for you to get a return that is lower than the original yield to maturity at which you invested. In that case, when you're analyzing what are the drivers of return on bonds? So if the return in this case, you say that there is the income elements and then there's the interest rate element, so that there's the possibility for interest rate to go up, but then the return on the bond will go down. There's also the possibility for interest rate to go up and the return on the bond will increase. Then what is the reason? So the CFA, they know you can calculate, but they want to know whether you understand what it is. So it takes us to something like this. Let me show you where those type of questions appear. And a lot of students, they look at it and they don't know what is being discussed. So let me show you a typical one that appears like that. Just a moment. I'm trying to see if I can figure out one of such, because that's where they like asking this type of questions that will let you think. So let's look at this one, because that's sorry. Okay, so look at this. Look at something like this. An investor who holds a fixed rate bond to maturity will earn an annualized rate of return equal to the yield to maturity of the bond when it pitches. Then look at the two. An investor who sells a bond prior to maturity will earn a rate of return equal to the yield to maturity at pitches if the yield to maturity at sale has not changed since pitches. Then the third one is if the market yield to maturity for the bond, our assumed reinvestment rate increases after the bond is pitches, but before the first coupon date, a buy and hold investor realized return will be higher, or vice versa, than the yield to maturity of the bond when pitches. Then you look at the four. So something like this, if you don't understand it, it will be difficult to select what the answer may be. Are you getting me? So you realize it's not calculation generally, but intuitively, what does it mean? So let's look at the first statement, for instance. An investor who holds a fixed rate bond to maturity will earn an annualized rate of return equal to the yield to maturity. But this, for instance, is very simple. There is the reason why if you buy a bond, the yield at which you bought a bond is called a yield to maturity, which means that if all things are held constant, if you hold that bond to maturity, you earn the yield to maturity. So that's clear. Is it clear?
Yes, please.
Then the second one says that an investor who sells a bond prior to maturity will earn a rate of return equal to the yield to maturity at pitches if the yield to maturity has not changed. So if the yield to maturity remains constant, if you sell the bond prior to maturity, your annualized return will still be your yield to maturity. The third one is that if the market yield for the bond, which is our assumed reinvestment rates, increases or decreases, then what happened? This is where they want to text and see whether you understand these statements, because the calculations are here. So I believe that a lot of us understand what these calculations are, but the intuition is simple. Now let's look at a simple scenario. When you invest in a bond, I said that the sources of return are typically your the coupons that are coming when you reinvest the coupons. That's the income on coupons, or the interest on interest is number one source. The second one is that there's a change in the yield to maturity. As a result of that, the price of the bond will change. The third one is that the principal that you have invested is returned. Because if the principal doesn't come, then what is your return? Nothing. So then you ask yourself, if you bought a bond and your investment horizon is short. So if you bought a bond, it's 20-year bond, but then you intend to hold it for only 2 years. So we can say that your investment horizon is short term. So in this case, 2 years. Note that in a 2-year period, you only receive 4 coupons. So that if you only receive 4 coupons, then when you reinvest those coupons, they are not likely to generate enough revenue for you. Therefore, in a scenario like this, assuming the yield to maturity increases, what will be the effect on your return? Who can answer that question? From what we are discussing. Because if you understand, you know exactly what I'm trying to say. I'm saying that you bought a bond. It's a 20-year bond. The coupon on the bond, you only going to hold it for a short-term period, 2 years in this case. So if the yield to maturity of the bond increases from the time you purchase up to the time you want to exit your position, will your return will it be higher than the yield to maturity, or it will be lower than the yield to maturity, and why? So somebody will say, if you don't do the calculation, you won't know, but you can know without the calculation. Now let me explain what happened. When you hold a bond for 2 years, you receive the first year, you receive coupon. First 6 months, you receive coupon. The second 6 months, you receive the third, you receive the fourth, you receive. Then you sell the bond at the end of the maturity, which is 2 years, and then you realize whether there's a gain or a loss on the bond. Then when you add everything, you get your annualized, you get your return from, or your holding period return for over a 2-year period. You know how much you have made on that investment. That's your return. But in this case, because you only receiving 4 coupons, because first coupon, second, third, and fourth, you can only invest the 3 before maturity. So the income you are going to earn on the coupon will be very small. Then I said again that assuming the yield to maturity goes up, an increase in yield to maturity will lead to a decrease in the value of the bond. And as a result of the 18 years residual period for the bond, an increase in yield will significantly impact on the price of the bond, so that if the price of the bond is falling, it will fall significantly. In this case, you realize that the income effects you are getting from the coupons you have invested will be less than the price effect of a yield increase. As a result of that, with this scenario, the return on your investment will be less than the yield to maturity at which you invested. This is because the price effect, which is leading to a loss, outweighs the income effect, because there's only a short period for you to invest in the or you only receive only 4 coupons to invest. So you will not be able to generate a lot of income from the coupons that you have received in order to counteract the effect of a decrease in price resulting from an increase in yield. Is it clear?
Yes, please, it's clear. But Sylvester, I wanted to ask a question.
Okay, go ahead.
I heard you mention, so it's for 2 years. How come you're receiving 4 coupons? I thought it would just be 2 coupons.
Yeah, because
it's a semi-annual offer.
You see, bonds, anytime you are dealing with bonds, unless specifically stated, the assumption is that it's semi-annual payment.
Okay.
So when they give you a question that will price a bond and they are silent on the frequency of interest payments, note that it's semi-annual.
All right, sure. Thank you.
Okay. Madam, did you get my issue?
Yes, please.
So you realize that in the same vein, assuming that the interest rate, so an increase in interest rate means that the coupons that you are receiving, you can reinvest them at a higher interest rate, which means that your income will increase. But because an increase in interest rate will mean an increase in yield to maturity, the price of the bond will fall. But because you still have 18 years for the bond to run, the price effect will be more pronounced than the income effect. As a result of that, your overall return will fall. Then alternatively, assuming there was a decrease in interest rates, then the income effect will lead to a loss, but the decrease in interest rate will lead to a decrease in yield to maturity, which will lead to an increase in price. So there will be capital gain, and then the capital gain on the bond will outweigh the income that you are losing as a result of a decrease in interest rate. So in that case, your investment return will be more than the yield to maturity at which you invested. Are we getting it?
Yes.
Then they ask the question, what about if you're a buy and hold investor? A buy and hold investor, they are just saying that your intention is to hold a bond to maturity. That's a buy and hold. So instead of saying the first one that says that the investor who buys this and then hold it to maturity, so they will not use the word maturity. They just say you are a buy and hold investor. So if the bond is for a period of 10 years, they say you are a buy and hold investor, means that you'll be holding that bond to maturity, which also means that irrespective of what happens to the yield to maturity, the yield to maturity at which you invested is the yield to maturity is going to be your holding period return, because you are holding the bond to maturity. So it does not matter whether yield to maturity has increased or decreased over time. So long as you are holding the bond to maturity, whatever your holding period return it will be, whatever your holding period will be, your holding period return will be equal to the yield to maturity of the bond. Is it clear?
Yes.
Okay. Any other question or any other interesting area? And then you are talking about the duration as well. So duration, we ask ourselves, what is duration? What is duration? We said that duration is defined as the percentage change in the price of the bond resulting from 100 basis change in yield to maturity. Or it answers the question of what happens to the price of the bond if yield to maturity should change by 100 basis points. When yield to maturity should change by 100 basis points. That is duration. And remember that when it comes to duration, the question itself will give you maybe the change in yield to maturity can be 20 basis points, it can be 10 basis points, it can be 15 basis points, it can be whatever basis point. But interpretation is always with reference to 100 basis points. Are we there?
Can you
Yes.
please repeat that?
Okay, I'm saying that when you are calculating duration of a bond, and what is duration of the duration? We said that duration is simple. There are different ways of calculating duration of a bond. You can calculate the duration of a bond through what we call the Macaulay duration. It can be Macaulay duration, and we say Macaulay duration 1 plus the yield to maturity over that's the over 2, which is this is yield to maturity over 2, 1 plus yield to maturity over 2 is called to modify duration, or it can be where V minus V plus over 2 V not change in yield. That can also be the formula, which is the approximate duration. And we said that duration is the percentage change in the price of a bond resulting from 1% change in yield to maturity, and 1% is always 100 basis points. So it does not matter what the yield change assumption is. Interpretation is always with reference to 100 basis points. Is that clear?
Yes.
Hello, it's
Yes,
clear.
yes.
Okay. Then remember also that because they want to know whether you do understand. So the price yield relationship looks like this. As a result of that, duration assumes a straight line. So if duration assumes a straight line, then if the change in yield is infinitesimal, which is very small, then the difference, you are likely to be closer to, the difference between the actual price yield curve and then the assumed price yield curve, which we use for purposes of estimating duration, it will be negligible. But if the change in yield is significant, then it will tell us maybe you are supposed to be at point A when you should actually be at point B. So this differential is we call the margin of error. And this margin of error is why we introduce the concept of convexity in order to close that margin of error. So then convexity is basically saying that when you use duration to calculate the effects of a price change, or as the effect of a yield change on price, the price you are going to get is likely to underestimate the price of a bond with a reduction, with a decrease in yield to maturity, or overestimate the price of a bond with an increase in yield to maturity. So as a result of that, duration will bring you closer to what the actual or the real price change should be. So that we call it, it's like a margin of error that you are trying to close. That is the essence of convexity. And remember that convexity is just the duration, the first order derivative. And the first order derivative, those of us who are quant people, we know it is just the partial derivative of price with respect to yield to maturity. And then the second order derivative is what we refer to as convexity. If the bond does not have embedded options, then the bond's convexity is always going to be positive. If the bond has embedded options, then the bond's convexity is going to be negative. but whether it's going to be negative or positive depends on whether it's happening in the margin where there is negative convexity or not. Is it clear?
Yes, please.
You sure it's clear?
Yeah.
Okay. So any questions? It's revision, so bring your questions, right?
I'm Sylvester.
Yeah.
There's a question, there's an area in the chat box. It says understanding fixed income risk and fundamentals of credit analysis.
Mm-hmm.
That's from Kofi. That's the area that.
Let me see. Bond duration, conversely, spread questions confuse me, especially the intuitive questions. Is that the one? Is that it?
No, there was one that you missed. I think when the call dropped.
Okay, so
there's one from Kofi also and Sam.
So if
the
person can send it, they put it back, then I'll take a look at it.
Okay, I'll do that shortly.
Because I don't have it here. Okay. So one is a understanding of fixed income risk. So this is where we are. That's what I was talking, the sources of return. That's what I was discussing. Then the next thing we want to talk about here is the Macaulay duration. Are we conversant with how Macaulay duration is calculated? Are we all okay with that? Or you want some level of, you want me to take a look at it for you? Hello.
Yes, Sylvester, we can look at this briefly.
So we should. So let's look at the one that we have here. Let's look at the example here. It says that consider a newly issued 3-year 4% annual pay bond with a yield to maturity of 5%. The present value, so we want to calculate the Macaulay duration of this particular bond. So pay attention to the question. It says it's a 3-year bond, and this 3-year bond has a coupon of 4% and is payable annually, but then the yield to maturity is 5%. So we want to calculate the Macaulay duration. This is how we calculate Macaulay duration. So take note. I'm going to do, so I put period 1, period 2, period 3. So this is the years or the periods. What are the cash flow? 4%, assuming when I go back to the question, the face value of this bond is 1,000. So if it's 1,000, then what is 4% of 1,000? I believe it's 40. And 4% of 1,000, the second year you receive 40. The final year you receive the 1,000 you have invested plus the 40, so 1040. Are we getting there? What is the present value discount factor? The present value discount factor is 1 over 1.05. Do you know where I got the 1.05? 1 over 1.05 squared, then 1 over 1.05 raised to the power 3. You know where I got those things from?
Yes, please.
Okay, so if you get that one, remember that if you multiply, let me call this one A. Let me call this one B. If you multiply this and you take the summation of that, what do you get? What do you think is that? If I call the second column A and I call the third column B, and I'm saying that if you multiply 40 by 40 times 1.1 over 1.05, then 40 times 1 over 1.05 squared, then 1040 times 1 over 1.05 raised to a power 3. If you sum them, what do you get? If I sum them from period 1 to period 3, what do I get? That would be the price of the bond. Is that okay?
Yeah.
Which also means that with your BA 2 plus, N is equal to 3, I over Y is equal to 5, payment is equal to 40, face value is equal to 1,000, compute price or compute present value. That is the same thing. Is that okay? If you are
Yes,
using
please.
you are using PA2 plus.
Yes,
So,
please, that's fine.
so when you do that, you get a price. And remember that when you multiply, so instead of calling this one A, B, let me call the first column A, the second column B, the third column C. So if I multiply 1 times 40 times 1 over 1.05, then I do 2 times 40 times 1 over 1.05 squared. Then I do 3 times 1040 times 1 over 1.05 squared. And I sum these values here. When I divide that one by price, what I get is Macaulay duration. Is that okay? You can work it out. You get the same answer as what is in the book. So you can try it. I don't know where my calculator is. But that is how we calculate Macaulay duration. Is it clear?
Yes, please. So Macaulay, you multiply the years by the
Year times cash flow times present value discount factor. Then you put it as the column D. Then you put it in column D. Then 2 times 40 times 1 over 1.05 raised to the power 2. Then 3 times 1040 times 1 over 1.05 raised to a power 3. Then you sum those ones together. When you sum, then you divide by the price, which is the B times C, which I have already referenced as the price.
Yes.
You divide the summation, which is the one in D, by the price. What you get is Macaulay duration.
Okay, sure.
Please, is it clear to everybody? Hello, is it clear to
Okay. Yeah,
yes?
but I'm more familiar with the alternative formula.
Okay.
The 1 plus R over R minus 1 plus, yeah. This one seems a bit too long for me.
So which one do you use?
I use the formula, the alternative formula, the 1 plus R over R minus 1 plus R plus
1 plus R over
R.
Okay.
Then minus
1
plus R.
1 plus R.
Big brackets open. The square brackets. N times brackets open. C minus R.
T minus R. So this is what you use. All over what?
All over. No, the all over starts from the second part of the, yeah. So
Okay.
all over C times brackets open 1 plus R.
Okay.
Raised to the power N minus 1.
Okay. But you see,
Plus
you see the formula you have quoted.
Yes.
And the exam's condition that you have 1 minute 30 seconds. How do you remember this is to use it? How do you remember all this formula? Because you see the CFA, let me tell you one thing. Something that you can do logically, don't memorize the formula for it, because you can forget. Under exam's pressure, you can easily forget. So something you can do logically. You learn the logic, do what you can do logically. So normally the CFA, if you memorize formulas on the day when their condition is on you and you are faced with 120 question or something, you understand? You
I can't hear you.
I thought I was the only one. Okay, so Sylvester is off.
Hello, Sylvester.
I'm trying to connect with another device. So, like I was saying, when you are learning, if it is possible for you to do something without recourse to the formulas, it's better. Okay. So one of the things that I encourage people to do is to know how to use the calculator extensively for most of the things, most of the calculations, because exam condition, your formula may be okay when you are just working in the office. You understand?
Yes.
But under exams condition, pressure can cause you to forget. But if you have used it for anytime you calculating and you've been using it and you are familiar with it, then it is okay. But when you are in trouble, then remember what I did, okay?
Okay.
Hello.
Thank you.
Hello.
Yeah, please go ahead.
Sorry, please can you go over the ending part of the market duration? Have used.
Can you come back again?
I was saying the Macaulay duration, the ending. I didn't get it. You like what you were going over. You said we'll multiply the year by the cash flow, and then you multiply it by 1 over the 1 plus 0.05.
Okay. Please give me this thing right, the host rights from this one. I disconnected from the other one so that I can show my screen. Okay, thank you. So let me go to the whiteboard. What I said was this, that if for a 3-year period, 1, 2, 3, 4, all you need is a column 4. But normally, you see, if you've been working with Macaulay duration with this thing, all I know is that there's 1, there's a 2, there's a 3 here. There's 40, there is 40, there's 1040 here. Then I know it's 1 over 1.05, 1 over 1.05 squared, 1 over 1.05 raised to power 3. So all that I'm going to do is that, do you have your calculators there?
Yes, we do.
Yes, please.
Yes.
Do you know how to use the memories?
No.
What use what?
No.
Okay. Anybody has a soft copy of the calculator? Okay, that's okay. So let me show you something. When you go to the calculator has 10 memories. Okay. The first memory is 0. So second function, you see m something on the body of the calculator. So press second function 0. You see something inside. Second function 0. What do you see?
Yeah. M0.
M0.
MO.
Press second.
MO equals 0.
Press second
MO
function 1.
equals 0.
Okay. Press second function 1.
DT1 1231 1990. Is that it?
Okay, that's okay. When you press when you press M01, let me show you something. This is how we do this one. I want to answer the question of it is too long. That's what I want to answer. This is how we start. You will go like this. 1.05 raised to a power is YX on the calculator. Then you put 3, you put equal to what? Do you see it? 1.05. Then you press y over y raised to a power x. There's a function y raised to a power x. Then you press 3. Then do equal to what? All of you do it. What do you get?
1.1576.
Pardon?
1.1576.
One. Okay, so press. You see on the very left side of the calculator, you see STO. Do you see STO somewhere?
Yes.
Yes.
Press that one and press 0. Once you see the answer on your screen, press ST0 and press 0. So you put it in memory 0.
Okay.
Is that okay?
Nothing. Yes.
Okay. Nothing
Okay,
happens.
Pardon?
I said nothing happens.
Yes, nothing will happen, but you have
Okay.
pressed it and nothing will happen. Now put your calculator off and on. Let me show you something. Off and on. So you don't see anything on the screen. There's nothing on the screen.
Yeah.
Do you see RCL or something?
Yes, RCL.
Press RCL and press 0 again and see whether you get the same thing. The one you put there.
Yeah.
You put it, you see it, right?
Yep.
Yeah.
Yes.
So off the calculator again and on it. Off and on.
Okay.
So now take 3 times 1040. 3 times 1040. 3 times 1040.
1040.
But
420.
it's 420, right? Now,
No, sorry.
No, don't do it in your,
120.
don't do it in your head. Use the calculator. 3
Yes,
times
yes.
That is
1040.
3120.
Yeah. 310.
Now press the multiplication sign.
Multiplication sign.
Are you there?
Okay. Yes.
Yeah.
Now then press recall 0.
Okay.
Then equal to what?
Okay. Yeah.
Now press
3611.79.
okay. Now press again ST0. Then press 0 again.
Okay.
Are you with me?
Yeah.
Yeah.
Okay. Now you see what we have done here. Under exams condition, this is what you would have done. You see, when they ask you to multiply this one, let me show you. It is very, very, very easy and quicker to use the calculator and do the Macaulay through this formula. This is because all that you need to do is to say 3. Oh, where's the pen? 3 times 1040 times 1.05 raised to the power minus 3. That's all you do. You understand?
Yes.
So how do we start this one? You do 1.05, then you press y raised to the power x, then you press 3, then you come to the bottom of the calculator, you see some minus sign there, then you press the minus sign. Then you say it's equal to what? You will not use the memory. So 1.05, then you press the y raised to the power x, then you press 3 minus. The minus is at the bottom. You see the minus sign. So you see the minus in front of the 3. Then you say it's equal to what? You get that?
Yeah.
Yes.
Then multiply by 1040 and then times 3. So you multiply that by 1040, then you multiply by 3. Then you say it's equal to what?
2695.17.
Is that what you got?
Yes.
So now press XT, then you press 0, so that you put it in 0.
Okay.
Then the second one will go like 2 times 40 times 1.05 raised to the power minus 2. So you use the same type of, so 1.05, then you press the y raised to the power x, then you press 2 minus times 40 times 2. Then you press store in 1. So instead of 0, you store in 1. Is that okay?
Yes, please.
So are you done with that? 2 times 40 is 80. So you can just do, instead of this one, you know, it's 2 times 40 is 80. It's easy. So 80 times or 1.05 raised to the power minus 2, which is which is the same as 1.05 times 1.05 y raised to the power x 2 minus equals to times 80. Then you store in 1. Is that okay?
Okay.
Yes, please.
Yeah.
Then the
A quick
next
one. Please,
Mhm.
how many decimal places should we leave in our calculators? Before 2.
Pardon?
Decimal places we should leave in our calculator.
Yeah. So you can reset it to 9 decimal places. That's fine. Normally, I
9.
use 9 decimal places.
Okay.
I use 9 decimal places because it doesn't. Yeah. So then the last one is just going to be 40 divided by 1.05. You see, so you are not going to use a 1 and all those things. So the 40 divided by 1.05. Then you say plus recall memory 0 plus recall memory 1 is equal to what? So it's you can do it very easily and quickly when you understand it and you know what to do. Madam, are you? So the formula you have quoted, when I use this method, I'll finish before you finish. Do you understand?
Yes.
When I use this formula and I use with a combination of the memories and all of that, I'll finish before the formula she quoted, she will finish. And whatever you get as the solution here, then it's just a matter of the time value of money is N, I over Y. Then there's a present value, there's payment, and then there's face value. You put 3 here, you put 5 here. Then this is the one you are looking for. You put 40 here, you put 1,000 here. Then you compute present value. So whatever value you get, assuming you put it in memory 0, you divide by whatever the present value here. What you get is Macaulay duration. If you don't use the memories, you can't be fast. So you need to use the inverse function. Inverse function is critical. Inverse function. The other way of using inverse function is 1 over 1.05 raised to the power 3. You could do it. You start from the denominator and say 1.05 raised to the power 3, which is 1.05 y x. Then you put 3. Then when you are done, you press 1 over x. You see the 1 over x function. So it makes it 1 over that. Is that okay? Or you go directly by putting a minus here and working with it directly. So either you work with a minus or you work with the positive, and then when you are done, you press 1 over x. It's part of the calculator. Is that side too clear? Hello,
yes.
Is it clear?
Yeah.
You sure it's clear?
Yes,
So anytime you are working on 1 over, let's say, 1.07 raised to the power 8, we either do it 1.07 yx minus 7 or 1.07 yx 7. When you are done, you press 1 over x key. 1 over x key. Is that okay? So those are the 2 ways of doing it. And then remember to always use the memories. Put something in memory. Remember which memory you put it. You recall it because you need that figure as part of your calculation. So if you put something in 0, you put something in 1, and it's multiplication, then recall times this, recall times this. If it's plus, recall plus this, or plus, recall this, plus, recall this. That's how you use the memories. Is that okay?
Yes, please.
Because the whole of this is about speed. So for instance, if I want to calculate, for instance, how many of us are familiar with the formula for duration? Approximate duration, I say, is V minus V plus over 2 times of V naught change in yield. Is that not the case?
Yeah.
So V minus means that assuming I have N in a scenario, N is 3 years, then we say the coupon is 40. Then we say yield to maturity is let's say 5%. Then we say face value of this bond is 1,000. assuming the yield to maturity changes by 20 basis points. 20 basis points. So in this case, I am looking at 3 scenarios of price. I'm looking at when the price is when the yield to maturity at 3 different scenarios. So I'm looking at when it's 4.7, it's 20 basis, so 4.8. I'm also looking at when it's 5. I'm also looking at when it's 5.2. Is that okay? So in this case, it's just a matter of saying that the N is already in the calculator. Payment, which is the face value, is already in the calculator. Face value is also in the calculator. So the only thing I change is the Y over Y. So I'll put 4.8. Then I compute price. Then I put in memory 0. Then I change that one again to 5. Then I put in memory 1. Then I change the other one to 5. I change the Y over Y to 5. I compute again. Present value, I put in memory 2. So already I have all these 3 values in memory 0, memory 1, and 2. So now the next thing is, because I started with the lowest, which is 4.8, I know it's the one that is going to be the highest price. Then I have the intermediate price, which is the one in memory 1. Then I have the lowest price, which is now memory 2. So I'm going to take now memory 1, memory 0 minus memory 1. Are you with memory 0 minus memory 2? That will give me the numerator. Then the denominator, because I know the denominator is in memory 1. So what if I do that? If I take the memory 0 and memory 2, the differential, I'll put it back in memory 0 so that I don't need memory 2 any longer. So I now have 0 and 1. So I'll take the memory 1, which is my normal price, times the 2, which is in the formula, times the change in yield, which is the change in yield is 0.002. Then when I'm done, I'll divide whatever I get here by what is in memory 0. Then I'll take the inverse function, because what I want is the numerator is what I have divided the denominator by the numerator. So now I need to find the inverse function so that it becomes numerator divided by denominator. You understand? Are we getting there? So that is how we get speed on the exams. It's not, you can learn, but you need a speed. And the speed is from the way you understanding of how to use the calculator. You understanding of what to do in order to gain that speed. Please, are we getting there?
Yes.
So you cannot be calculating duration, and you are saying the duration formula is P minus P plus over 2 P naught change in yield. And then you calculate this one by saying N is equal to 3. You go back and be entering all the digits. No, the only thing that is unknown, the variable in this case, is the yield to maturity. So it's the only one you'll be changing and recalculating the price. Once you are done, know what you put in which memory, and then use the memories aside. But remember that you can, when you find Y divided by X, if you start by saying X divided by Y, then when you are done, you press 1 over X function, then it becomes Y over X. Is that okay?
Yes.
So if I do X over Y, but what I want actually is Y over X. Then it's just a matter of X over Y. Then I'll press the 1 over X function. I'll press that one, then it becomes Y over X, and vice versa. So that is how we use the calculator. So the financial calculator we are using, it does not matter whether you did numerator over denominator or denominator over numerator. It doesn't matter.
Okay.
Pardon?
Sure.
Okay. Any other questions, please? Please, do you have any questions for me?
Hi, Sylvester. I don't really have questions for you, but I think if you could mention or take us through certain few things you think are pointers that we should like to take us through for the exam, prepare us for the exam. I think that would be fine. Personally, from where me I sit, I'm writing on 23rd, the honestly. I've taken
23rd of this
leave
month.
Yes, I've taken leave to study, but I've not covered anything. But I don't know. I'm just, but thankfully for what you've taught us today, I have an idea about it. But I'm still pushing and pursuing the studies till then. I don't know whether now I should just wait to just pass.
I didn't get the final bit of your submission.
Be learning from the past.
Yes, you need to solve questions as well. So if there's a question bank, you go through it. Normally, when you have about a week or two to the exams, you open the book and then you solve questions. When you are solving the question, you can't get it, you go back to the book and refer. And then you are flipping between the book and the questions in order to just get the ones you don't understand, you try to fix them in. The ones you do understand, you move on. Do you understand? So it is always a fusion. So you're just going to be looking at, do I have to read this topic quickly and solve questions? Yes, because I didn't get it. So you combine the two. By the time you are done with solving the questions, you are fine. So that's how it goes.
Sure. Thanks a lot.
Yeah.
Hello, Sylvester.
Yes.
Okay, so for me, I'm also writing on the 24th of this month. That's in barely 2 weeks. But I've been doing the curriculum since February. I registered. I didn't do too well the third-party prep materials, and I was solving the questions as I studied, and I've taken the first mock actually, and well, I got 64% on the first mock. I've not taken my second mock because I'm not revising. But I've studied entirely from the curriculum, and I'm doing just the question bank in the learning ecosystem. I don't know if that's enough, because I've seen a lot of people from other countries, I mean WhatsApp groups where I belong to, talking about what's the name? Question bank, and I have to, yes, question bank. And
okay, so if you get, it's not a problem to reading the curriculum is the best. This is because you will then be able to cover every area of the contents for purposes of the exam or the body of knowledge. Solving questions also in the curriculum is good because the people who are setting the exams, they are not third-party vendors. They are CFA people. So they will typically set questions from the main source, which is the curriculum material. But that notwithstanding, looking at majority of us who are working, there is constraint as to your time. And because there's constraint as to your time, that is why people sometimes resort to third-party vendors or materials from third parties. And when they do that, for me, if you know a particular topic, it does not matter whether you read it from another textbook or wherever you get it from. Duration computation is the same everywhere. Convexity is the same everywhere. So some of the top subject areas is the same everywhere. So when you read from the curriculum and you don't understand it, and then probably there's another way of getting it, that's fine. But what I'll say is that 2 weeks to the exams, it is critical that if you have maybe the Schweitzer question banks, the question bank from Schweitzer, you can take a look at it whilst you also prepare for the mock. That will help you. Is that okay?
No. Okay.
The reason is that when you take Schweitzer, for instance, it is tailored to writing exams. But if you want more knowledge, it's better to go to the curriculum. But the curriculum is the critical one to use. I don't see how we can do it without the curriculum.
Because I realized when I started preparations, I started with the Schweitzer notes. But when I attempted the end of chapter questions. At least the intuitive questions were, I don't know, but CFA kind of picks them almost like verbatim from their book. So when it
Yes.
comes to calculations, you do very well with the script material. But when you take the intuitive questions, you realize that the curriculum really helps with that. So I just had to switch because it wasn't really helping equations. Yes. So I just stuck with the curriculum.
Yeah, that's fine. So it's a matter of whether or not you have time to go through it, because it's quite voluminous. But then if there's time, the best is the curriculum. I'll give you an example. In my case, when I wrote the first level 1, I think level 1, I wrote it somewhere in 2002.
Wow.
When I did level 1 in 2002, I used a third-party resource. And I think apart from equity valuation, I got below 70. The rest of the papers I got above 70. Then I use Schweitzer again for level 2, and that one too, I pass it when I wrote it. Then the level 3, the first, I became complacent actually. So I wrote the level 3 the first time, I didn't get it. The second time I said I was going to use the curriculum material. I didn't finish reading. Those times they didn't prepare curriculum. They were giving us textbooks. They tell you these are the textbooks, derivative textbook, this is it. Fixed income, this is a textbook and all of that. So they were quite voluminous. So I couldn't finish reading on time. I was not well prepared. So when I wrote this level 3 the second time, before I was going to write the paper, I realized I hadn't finished reading. Therefore, I was not going to pass, because CFA can't go in when you are not prepared. Well, once you are not prepared, the probability that you pass is low, especially when during our time level 3, there was a portion that was the Vianet, which is they ask the question and then they set the subjective under it, and then you take the ones that are appropriate for the scenario. And then there's a place that you write. So if you don't know, you can't write. And writing was 50% of the whole thing. And then they give you a scenario and they ask questions on it, was also another 50% for it, was 60 questions for 50%. So I didn't do well. So I came back to Schweitzer. That was when I was going to write it for the third time. I came back to Schweitzer, and that time I really prepared. So I went through it well. So that's my experience about the whole thing.
Oh, okay.
Yeah, and I do recall when I was going to write FRM, I used Schweitzer for like 2 weeks for part 1. Then I used it another 2 weeks. I didn't have time. So when I was going to write part 2, I used 2 weeks and I failed. So I waited again. I used another 2 weeks and I passed the part 2. So that's how FRM. So it depends. Do you understand?
Okay. Please, I have a question.
Oh, yeah, go ahead.
Okay, so understanding percentage change in the PV4 as compared to price impact of a bond change or whatever. I don't know what's the difference, because the formulas kind of look a bit similar.
You are saying that percentage change.
Yes, percentage change in PV4.
Okay, the percentage change in price, right?
Yes.
Versus holding period return.
Price impact. No, versus price impact.
Yes, so percentage change looks more like price impact. But remember that percentage change does not take into account time. So once it doesn't take into account, it's not an NPV calculation. It is not internal. Sorry, it's not internal rate of return calculation. Let me show you. Let me give you an example. Okay, so we can be on the same page. Are you there?
Okay. Yeah.
So if I say you bought something period 1, and you bought it, and then you sold period 4, and you bought it at 90 and sold at 120. What is the return? If you use percentage change, you go second function. Is it 4 or 5? Which of them gives you percentage change? I have forgotten. Check there. You see percentage change on the body of the calculator.
It's 5. It's
yes.
5.
So press second function 5. Then tell me what you see. You see
old.
New. You see old. Then press
Yes.
the down arrow key. The down arrow key. What do you see?
You see new.
The down arrow key again. What do you see?
A
percentage change. Then use the down arrow key again.
Yes.
Number of periods.
You see number of PD, yeah.
The number of periods. Okay.
Yeah.
So if I ask you to enter this one, the old value is 90. So go back to where you see old and 90, then press enter key. The enter key.
Okay.
Okay. When you enter it properly, you see some small arrow on top of the number. Small arrow. If it's not there, it means you have not entered it.
Yes,
it's very
entered.
So you see, did you see the small arrow?
Yes.
So you go to the new and then enter 120. 120 enter. Then you see the small arrow on top of the 120.
Yes,
again.
I've seen it.
Then go to percentage change and then press compute. When you see percentage change, press compute. What do you get as a percentage change?
33.33.
Pardon?
33.33%.
So 33.33. This is the percentage change. But now go use the down arrow key again. Use the down arrow key again and go to number of periods and enter 4. Enter 4 at number of periods and go back to percentage and compute. So enter 4 at number of periods and go back to percentage and press compute. What do you get?
7.4569.
7 point what?
4569.
So this 7.46 approximately. This is the price. This is the price effect on the return. But the first one is just percentage change. Madam, you see the difference? Do you see the difference? Is she there?
I think she's having network issues.
Okay, so this is the difference between percentage change and the price effect. But remember also that the same thing I asked you to calculate, we could then have done it. We could also have used the formula this way. 120 minus 90 over 90 raised to a power 1 over 4 minus 1 times 100. You get the same as 7.46. You can do it manually, I see. So that is what the calculator gives you in percentage change. When you change the number of PD to 4, you are this formula is in it. That is why I will not learn this formula. I will learn how to use the calculator to do it. Because under exams condition, when I'm writing this one, it will take too much time. Is that okay?
Yes, please.
Yeah.
So this is, or you do 120 over 90 minus 1. Raised to the power 1 over 4 minus 1 all times 100. It will give you 7.46. Approximately what you got before. So you see, you do more simplification because 120 minus 90 over 90 is as much as 120 over 90 minus 90 over 90. That is why I got 120 over 90 minus 1 before I do. So it's the same thing. Are we there?
Yes, we are here.
Okay. So that's how this one too works. Any questions somewhere? It's revision, so I haven't prepared myself to come and teach. But if you want a specific topic too, I can take a look at it. But I want us to broadly look at what we are doing and ask questions. So yeah, in my reading, I came across so and so. And I want you to share more light on it, then I'll take a look at it. Or if you have some specific area you want me to touch on, I'm here. We still got about 30 minutes.
Sylvester, on the convexities, right? So the embedded options, I put in here that putable bonds have positive convexity, callable bonds have negative convexity. I don't really understand it. How does it work? Can you shed a bit more light?
Okay, so this is what you are trying to say. Okay, let me show you. This is a whiteboard. Can you see my drawing?
Yes, please.
Yeah.
Okay, so assuming that the original, this is the price, this is the yield to maturity. This is the yield to maturity original, this is the price original. A bond that has, if it's a callable bond, we are saying that the investor has the issuer. Remember that in bonds balance, there's the issuer of the bond, and then we have the investors in that bond. When we say the bond is a callable bond, we are saying that the investor, the issuer has the right to ask the investors to bring whatever certificate or whatever bonds we have issued to them for their money. That is a callable bond. A putable bond, we are saying that the investors have a right to bring you your certificate and take their money. So they can put it to you and take their money, or we can call it. So if the issuer can call it, there is a callable bond. If the investors can send it, then it's a putable bond. They put it to you, or you call it. Is a distinction clear? If it's clear, I go to the next. So now, if the bond is a callable bond, who has the right to call it? Is it the investor or the issuer?
The issuer.
So if the issuer has the right to call it, then we are saying that the right to call something is an option, and it's a call option. Is that okay?
Yeah.
Because they have the right to call, so it's a call option. So they need to pay some premium for it. Is that not the case? Since they want to have a right to call the bond, they need to pay some price for it, and that the price they pay for it is called the premium, the call premium. Is that okay?
Yeah.
So if they are paying the call premium, then if the issuer has two categories of bond, and they are all 2 years, the same issuer, so the credit risk is the same. The tenor is 2 years, so the tenor is the same. Then, given that one is a callable bond, the other one is not a callable bond, which one will be more expensive if you are buying the bond? Or which one would investors prefer, assuming the yield to maturity on the bonds are the same? What do you think? Which one do you think investors would take? So this is how logically, that's how we think through the scenarios. So if the issuer is the same, the tenor is the same, and one is a callable, but one is an option-free bond, which one will you prefer as an investor? What do you think?
A putable bond.
No, one is a callable, but one is option-free. So the same issuer has issued two categories of bond. One is option-free, the other one is a callable bond. Then I'm asking, if all the parameters are the same, where are you going to put your money?
An option free.
So you put your money in option free because the issuer does not have any rights to call the bond. So for me to be different between the callable bond and the option free bond means that the option free, the callable bond must be cheaper than the option free for me to be able to invest in, to be indifferent between the two. Do you understand the point? Because if you are saying that option free is what we will prefer if all the parameters are the same, then for me to be indifferent between the two, one of them must be cheaper or one must be more expensive. So if the callable bond is cheaper, then obviously I would now be indifferent. I don't know by how much cheap it is, but I'll be indifferent between a callable bond and option-free bond. The difference between the callable bond and the option-free bond is what we call the call option value, or the call value. And this call value, it can only happen at a point. So under what circumstances would an issuer call a bond? An issuer will only call a bond under certain conditions. What is the key reason for calling a bond? The key reason for calling a bond is that I have issued a bond at 25%, and I want to have the right to be able to ask you to bring your certificate for your money when the interest rate environment is favorable to me, so that I can now go back to the market to reissue the same bond at a lower rate. That is why normally in a decreasing interest rate environment, call options are likely to be in the money, and that issuers are likely to call their bonds when interest rates are lower or when interest rates are falling. So you realize that as a result of that, this region that I'm taking, the region here is what we refer to as the portion where the bond is likely to be called. Any place above, beyond this line, nobody will call a bond and issue at a higher yield. Nobody will do that. So this area is no-go area. Can you see it? But this portion, we can call the bond. But if the change in interest rate is very small, nothing will happen. So when they are calling the bond, they have what they call the first call option, the first call price, the second call price, the third call price. We can also have the first call price, the first call, the par call date or par call price. So if we are calling, we can have a bond that is being called at 105% of the face value, 103% of the face value, and then maybe the third year is at 100%. So the first year that is being called at 105% is the first call date or the first call price at 105. If the second year is called at 102, that is the second call price. If the third year is being called at 100%, that is the third call price. And the third call price, which is 100%, is also called the first par call price, because that is the first time it's being called at par. Is that okay? So because prices are fixed, as we fix it at 105%, then irrespective of what happens to interest rate, the price will never go beyond the call price. So this curve that we have that goes this way now becomes like this. So you realize that this is convex, but at this point it becomes concave. And because it becomes concave in the region of 105 where yields are lower, that is why we say here there's negative convexity, because convexity is this way. So because it has truncated and there's price compression at 105, that region where the price has compressed, where it cannot exceed 105, is what we call, that region is the region of negative convexity. Is it clear?
Yes, please.
Yes.
Is it clear?
Yes, please.
Okay. So if that region is the region of negative convexity, so that is the point where convexity becomes negative. And what we are saying is that when the bond does not have embedded options, convexity is always positive. But when the bond has an embedded option, specifically a call feature, so that it is a callable bond, there are regions of the interest rate below which the bond then becomes, or the bond will now have negative convexity. Is it clear?
Yes.
Yes.
Oh, okay. And the same thing we can illustrate with putable bonds as well. So if I want to illustrate with putable bond, it's the same this way, but we get a point where the put option can go this way. So it is at this point that the convexity is still convex anyway, but typically this is you are not going to get a putable bond that is going to give you a curve that looks convex to the origin. But it just that the steepness of the convexity differs as a result of the put option. But what is the put option? A putable bond is a right that is enjoyed by the investors. As a result of that, all things being equal, a putable bond is more likely to be expensive than an option-free bond, because you pay the value of the option-free plus the put premium that you are paying in order to have the right to put the bond at the future dates. Is it clear?
Yes.
Okay. Any questions?
Yes, please. I have a question, but it's an alternative investment.
Okay, go ahead.
The fee compensation calculation fee structure for, I think it was hedge fund. I saw it on the mock. I went there how I know it, but I still didn't get the answer. So I was a bit confused. Just I didn't mark the question for review.
Okay.
But what I remember was that I think it was a 2 and 20 fee structure. And
220.
yeah,
Other 10,
yeah, 220.
other 10.5 or 220. Okay.
Yes, it was 220. And I think it was initial committed funds was I think 100 million. And then at the end of the period, they made 120 million. So we're supposed to calculate the total gain.
Let me tell you something. When it comes to compensation and fee structure for hedge funds, the first question you need to ask yourself is what type of structure the hedge fund is he a 110 or is he a 220? If it's a 220 means that are we charging 2% flat on the initial value? It is the beginning of period value that we charge the 2% on. Then we look at how much the fund had grown over time, and then we look at it and say, okay, if you do nothing, which is a laissez-faire attitude towards fund management, we'll give you 2% of the value under management at the beginning of the year. Is that okay? That's the 2%. Then we are saying that we would give you something in addition if you meet certain benchmarks. So we set a return benchmark for you. And then we are saying that the return benchmark that we set for you is either we have a soft hurdle or a hard hurdle. A soft hurdle is saying that if I set a benchmark of 15% and you make 25%, then in addition to the 2% that I'm paying you for managing the funds under your custody, you are going to calculate because you exceeded the 15% and you made 25%. I'm going to start from 0 up to the total return. I'll give you 20% of the total return. Is that okay? That is soft hurdle. If it's hard hurdle, I'm saying that the 15% is why I'm paying the 2%. So the 2% I'm giving to you because I want you to do some work. So if 15% is what I said for you, making the 15%, you haven't done anything because that was our agreement. Therefore, 15 to 25%, you've made 10%. So 10% of I'll give you the 20% on the 10%. Are you with me? That's hard hurdle.
Yeah.
Then hard hurdle is not enough. Then there's something they call whether, I have forgotten the term, but whether or not you have made losses in the past or you have not made losses in the past. So if in the past I told you to make 15% and you made 10%, then you owe me 5%. Do you understand?
Yeah.
If last year I asked you to make 15%, you made 10%. Therefore, you owe me 5%. Do you understand? Therefore, if this year you made 20%, go and Teokano first. Go and take the money you didn't make last year, Teokano first. Then what if I is left? We can talk about the difference. Then we'll see whether we'll do the 20% on the difference. You know that kind of thing.
Yeah.
So that's the idea of the whole thing. So we say whether there's a tight watermark or there's no tight watermark. Are you with me? Whether there's soft hurdle or no soft hurdle, or there's tight watermark or there's no tight watermark. So look at it logically and ask yourself, if I'm managing the funds, beginning of period value, the asset under management, 2%. No question about that. Whether I'm going to earn the 20% depends on my performance. But that performance can be from 0 up to how much, the whole amount you made in the year, or only the portion that is above the return we have agreed. So if you make the whole...
The question, yeah, so the question, they asked that you calculate the fees separately. So you calculate the 22% on the committed capital, then 20% on the then you made. So after that, I subtracted the 120 from the 100 from the 120 and got the 20 because we made 120 at the end of the period. So after calculating the 20% on the 20 what's the name?
So the 2%
20
will be on
million.
yes.
So this is how I went about it. I calculated 2% on the 100 million and 20% on the 20
because that's
million.
That's the beginning of period value, right?
Yes.
Okay.
So when I did that and I summed everything together, I didn't get any answer in the possible answers because I think the first one was 0.9 million. The second one was something.
Did you pay
The third
attention?
one too.
Did you pay attention to whether it's soft header or hard header? Whether
No,
it's
I didn't see any.
So those are the things you need to look at.
Any header law. I didn't see any covenants in the question, so I was a bit taken aback.
I understand what you're saying, but those are the things we look at. So let's look at a typical example, okay?
Okay.
There is I want to see whether they use those words here. Sometimes they don't use those words. So it's either 220 or it's 110 fee structure. Okay. You can see my screen, right? Now I want to see based on this whether there's what type of fee we are looking at. I want to see calculate and interpret the alternative investment on both fee and river. I want the one on hedge. Where's the hedge funds? Oh, that's the hedge fund. Okay, so this is a hedge fund. I want to take a look at the question and see whether it's hedge fund. So it says that BJI is a hedge fund with a value of 110 million at initiation. It charges 2% management fee based on asset under management at the beginning of the year. So you underline at the beginning of the year. Are you with me? And a 20% fee with 5% soft hurdle rates. And it uses high watermark. Incentive fees are calculated on gains, net of management fees. The year-end values are given as follows. Do you understand the question? Hello, can you hear me?
Yes, please.
Yeah, we can hear you.
So look at the kind of words they put there. They say that what? A 5% soft hurdle rate. And it uses a high watermark. And it says incentive fees are calculated on gains, net of management fees. Then the year-end values are given as 100.2 and then 119 million, even though we started with 110. Now look at how the first fee was calculated. Management fee, because it's 2% of the asset under management at the beginning of the period, is 110. 2% of that is 2.2 million. So what is the return? When I want to look at that one alone as a return, then I'm saying that at the end of the period, I gave you 110 million and you were only able to transform the 110 into 100.2. Are we there?
Yeah.
We are only able to transform that one into 102. So what is the gross value at the end of the year? It's 100.2. So the return will now be, what do you think? Should it be 102.2 or minus 2.2, or should it be 102.2? What do you think? What do you think? Please, I'm asking a question.
Please come again.
I'm saying that from what I projected on the screen, should it be 100.2 minus 2.2 over 110, or should it be 102.2 minus that?
You see 102.2 minus 2.2 over 110.
Okay. Over 110, eh?
Yes, please.
So where do you think the 102 is coming from? Oh, I'm listening.
Honestly, I have no idea.
Okay. So we want to see the return in year one. What is I'm trying to figure out where they got the 102.2. I'm not getting, there's no incentive fee because the return after the management fee is less than a 5% hurdle rate. Total fee is this. Ending value for this will be this. So return after year one is this. Okay, so what we are saying is that if I take the return net of management fee, I'm trying to figure out where they got the 9.1 because it should be 10.9 thereabouts. Just a moment.
Yeah.
Just a moment. Management fee is 110. The 110 of this is 2.2 gross value at end of year. Gross values, and they say soft header means it's on incentive fee, 5% of soft header. So soft 100.2. Okay, so let me just try and explain it in a different way for us to just understand. So what we are saying is that a soft hurdle is saying that when they give you a return of 5%, whatever you get, in order to pay you the 20%, I am just going to look at whether you have been able to meet 5% in the year. If you have met the 5% in the year, I'm going to pay you the entire, I'll pay you on the entire amount you made in the year. So listen, I'm saying that I'll pay you bonus of 5,000 Ghana cedis, okay? But the bonus I'm going to pay you, I'll look at whether you've been able to exceed your target of three. So the three becomes something that I'm just going to look at. When you exceed it, that is why I'll pay you the bonus of 5. But if you don't exceed the 3, I'll not pay you the bonus at all. So the soft header is saying that if you started with 110, and then I asked you to make 5% of the 110. If indeed you make that 5% of the 110, then at the end of the day, I will pay you a return of 20% of the total amount that you have made. So looking at this, when we started with the fund management business here, the amount that I gave, or the amount under asset under management was 110 million. When I calculate 2% of that, it comes to 2.2 million. That 2.2 million, I subtract that 2.2 million from the ending value, which was 100.2. When I subtract that, I get 98. I divide 98 by the beginning of period value. What I get is 110 minus 1, which gives me minus 10.9%. This minus 10.9%, you have not met your target. Therefore, you get nothing. In terms of the 20%, you get nothing. Is that side clear? You get nothing. Then the second one is saying that so if I have the closing value of your investment was 100.2% and I'm paying 2.2, then the beginning of period value was 98. And this 98, 2% of it is 1.96. But closing the period, you got 119 million. If I subtract 1.96 from it, I get 117.04. Okay, end of value at year-end value net of management fee. Then the next thing is the high water mark is 110 million because that was the amount I've given to you to start the business with. So whatever losses you have incurred, you need to recoup those losses. So you realize that we took the difference between the 110 and then 107.04, which is 7.04. That 7.04 has 7.04 divided by 110 is giving me 6.4% as the return. So then if I look at your return, how much return have you made? Looking at a return here, year 2, I'm going to look at the incentive fee is going to be 7.04 times 0.2. But where from the 7.02? It is because I'm saying that I acknowledge the fact that you have made money of 109. But 109 that you have made, you are charging me 1.96 million as your management fee. Therefore, what is left for me on a net basis is 117.04. When you started managing the funds for me, I gave you 110. Therefore, the losses that you have made, let's go back to, because you closed the year by 98 was what you used to close the year. So fill in the gap. The gap is 98. And then the amount you started with is 110. So let me recoup the difference. So that is where we got to the 7.04. So we took 117.04 and subtracted the 110 from it to get the difference. So that any compensation I'm going to give to you will be based on the 7.04 after having recouped whatever. That's why I'm saying that if it's a hard hurdle, how much have you lost in the past? Recoup the losses before we start talking about your incentive. So you recoup the losses, then we talk about the incentive. The incentive is 20% of this. So we'll now calculate the 20% of the difference, which is the 7.04, which gives you 1.4. Then we add it to the 1.96 for a total of 3.37. So that the total amount you made was 119 minus the 3.37 that you are charging me in terms of fees. And this gives you a balance of 115.63. So that if I take the 115.63 divided by 98 minus 1, then I'll get 18%. This 18% is greater than the 5% hurdle that we set for ourselves. Is it clear? Is the intuition? Hello?
Hi.
Yes,
Yeah.
please.
So it's always the intuition. Whenever you are working on these things, you ask yourself, what have they put in the question? Is it soft hurdle? Or do they have a high water mark or low water mark? Is it soft hurdle or hard hurdle? Because the curriculum will tell you what to do if it's hard hurdle, what to do if it's not hard hurdle. I don't know where they have treated that one. Then I want to take a look at it and hedge funds. Let me see if I can get where they discuss the hard and then the soft hurdle. Okay, so take a look at this one. Is it the total fees paid by investors in an alternative investment funds often consist of management fee and incentive fee. The fund managers earn the management fees regardless of investment performance. So management fees are typically between 1% and 2%. For hedge funds, the management fees are calculated as a percentage of asset under management, typically the net asset value of the fund's investment. For private equity funds, it's based on the percentage of committed capital. Then committed capital that has not yet been drawn down is called the dry powder. The incentive fees are a portion of the profits on fund investments. Most often, the partnership agreement will specify a hard hurdle of return that must be met or exceeded before any incentive fees are paid. Hurdle rates can be defined in two ways, either hard or soft. For a soft hurdle rate, if a soft hurdle rate is met, incentive fees are a percentage of the total increase in the value of the partner's investment. With hard hurdle, incentive fees are based only on the gains above the hurdle rates. That's what I was trying to put across. Are you getting me?
Yes,
hard hurdle.
please.
Okay. So a fund with a hurdle rate of 8%, that's produced a return of 12% for the year, so that it has exceeded the hurdle rate. We will use the incentive fee of structure of 20% of gains. If the 8% is a soft hurdle rate, the incentive fee will be 20% of the gain of the entire 12%. If the 8% is a hard hurdle rate, then it will just be the differential. That's why I said that if it's hard hurdle, what I'm paying you fees to work for me. So if you have met your targets, there's no need to give you anything. So if your target is 3, if they do performance appraisal and your number is 3, and 3 is met targets, we don't give you anything, because that's what you are paid for. You've done your work. So why should somebody give you bonus for just doing your work? But if it's not like, if it's a hard hurdle rate, then anything that you get above your normal work, they give you a percentage of it. Typically, incentive fees are paid at the end of each period. But now look at this. There's a catch-up clause in a partnership agreement that is based on a hurdle rate and is similar in its effect to the soft hurdle. So consider a fund with a return of 14%, a hurdle rate of 8%, and a 20% effect. A catch-up clause will result in first 8% gains going to the limited partner. Now let's go to another feature that is often included is the high watermark. This means that no incentive is paid on gains that are only offsetting prior losses. That's what you mean. So you pay attention to what is it. Is he talking about high watermark or low watermark? Is he talking about hard rates or soft rates? So if you go back to your question, then the way you look at it is that there is asset under management. The asset under management at the beginning of the period, the 2% will be applicable to that. Then you go and calculate the return on the investment on a net basis. So you look at how much you started at the beginning of the period, how much you are getting at the end of the period. Then you subtract your management fee from what you are getting at the end of the period. Then you calculate your return based on that new value divided by the beginning value minus 1 times 100. Then you compare it to your hurdle rates. If it's a soft hurdle rate, then the total return, so long as you exceed the hurdle rate, whatever return you made, you calculate the 20% on that. But if it's hard hurdle rate, then you calculate the return minus what you are paid to do. Then you calculate the difference is what you get at 20%. Then in order to get from there, you look at the fees you have charged. Then you subtract it from the beginning of period, the end of period value. Whatever you get is the beginning of period value. Then you look at the end of period value again. Then you go to the cycle again, calculating your return. If it's hard hurdle or if it's a high watermark, then you look at any losses that you've made that you've not recouped. You recoup them before you calculate your incentive compensation on the rest. So that is how it is. So it's just logical. If we go through it logically, it's easier to understand and then get to the bottom. Is that okay?
Yes.
It's okay? Any other
Please.
question? So take a look at, if you have the choice, take a look at a few of them, because they've given you a few of them. Take a look at them, and then you see how you can, how they have gone about it. But pay attention to soft rates, soft hurdle, hard hurdle, high watermark, low watermark. Pay attention to those phrases, okay?
Okay. Sylvester, please, you have the Sweza question bank.
Yes, I think that's what I'm sharing, but
This is a question bank.
no, I don't have the question bank.
Okay.
I don't have the question bank. I don't have it.
The one on the floor has the...
So maybe, I'm sure any of our colleagues probably may have it. So we could check later on to see whether somebody has it. Then we take it from there. Any questions? Please, do you have any questions?
Personally, no.
Okay.
No, please.
Okay. So what I'll say in a nutshell is that the CFA, because you are being trained as an analyst, they want to see how you pay attention to details. That is why when they ask questions, they use keywords, and sometimes they put them in bold, they bold in those words, sometimes in italics and all of that. So what they're trying to do is that there's emphasis on a particular thing so that you pay attention. Not paying attention is why some people will learn and they will not pass. But when you pay attention, that's it. And find smart ways of doing things. Like I said from the beginning, if you are solving a question and then you think that you can maximize the use of the calculator, then go ahead and do that. Develop shortcuts whilst you learn. Practice as much as you can, because the more you practice, the better you become. You can read all the materials, but when you are not fast, you will not be able to finish solving the questions before time. But then your ability to solve questions depends on whether or not you've been solving questions. So those of us who have the question bank, we can share it with our colleagues. The beauty of our professional exams is that you are not going to get somebody who is first, somebody who is last. At the end of the day, we get it there. We go through different paths in our working life. Somebody will work in a bank, somebody is somewhere else. So let's share. When you have the material, let's not keep it. Let's share. And then that's the way. And when we are learning and we have difficulty, let's communicate. We have an association. So sometimes let's not limit the association issues to only we post things that are not too relevant. Sometimes let's put questions there if we have those questions. If we look at it, we would get back to you. And then just as we have the mandates, we would support as many students as we can. So that's what I want to say. But I wish you all the best. If you personally have things to do, you can contact me. If I have the time, I can explain things to you. And then we take it from there. Is that okay? So yes, thank you.
Please. Thank you, Sylvester.
Please can you share your phone number or something?
Fantastic.
Okay.